There's 145 homes on the market right now, not under contract, just straight up on the market that are offering loan assumptions. We'll get into it. You can see here is out of the 145 advertised assumptions, the pricing is like all the way as low as 100K to as high as 2.3 million, almost 2.4 million. So I don't know. This is a pretty good spread. It's pretty representative of most inventory on the island, actually. I don't know what is for sale for 100K. Maybe it's a leasehold. I don't know. Anyways, but that just means that there's a bunch of options. 145. I had no idea there was this many. I guess if you asked if I had to answer, I would say maybe like 50. I have no idea. But yeah, 145 active today. That's huge. So let's take a deep dive. There's 145 homes on the market right now, not under contract, just straight up on the market that are offering VA loan. No, offering loan assumptions, not just VA loan. Could be USDA, could be FHA. We'll get into it. But what you can see here is out of the 145 advertised assumptions, the pricing is like all the way as low as 100K to as high as 2.3 million, almost 2.4 million. So I don't know. This is a pretty good spread. It's pretty representative of most inventory on the island, actually. I don't know what is for sale for 100K. Maybe it's a leasehold. I don't know. Anyways, but that just means that there's a bunch of options. 145. I had no idea there was this many. I guess if you asked if I had to answer, I would say maybe like 50. I have no idea. But yeah, 145 active today. That's huge. So let's take a deep dive. This is just an example of one of the properties that's on the market. This is one of the most unique ones. This is a condo, a one bedroom, one bath in town. The current balance on the mortgage is $301,000. And they got a pretty good rate, 4.375%. They put down their mortgage payment for us. But what was so unique about this is that the seller was only asking for $304,000, 304,500, in order for someone to buy this home. So we'll look at numbers for something like that later. But think of it this way: $304,000 is only $3,000 more than the current balance. So whoever buys this place will basically inherit this mortgage, which is already, if hopefully at least a few months ahead, maybe a few years ahead. Something like this, the veteran probably financed their funding fee, and maybe they've just been paying that down. I don't know. I didn't look at it when they bought this. Regardless, the person buying this place would only have to bring, as they can see here, less than $5,000 down to cover the difference between the balance and the actual purchase price the seller is asking. And to be honest, you might be able to negotiate it. So there's a chance that you wouldn't even have to bring that much. Next one. This one is something I'm seeing a little bit more often. The loan balance on this property was a little over 800,000. Seller was looking for just under 1.2 million, leaving a gap of somewhere $364,000. How do you deal with that? That's a huge gap. We just went from one that was like $3,400 or less even. I don't even remember, to one that is now, we're talking six figures minimum, probably 300,000, maybe 250 if you negotiate it really well. So how do you deal with that? This is just another cool example, and we see also breakdown of the monthly mortgage. This interest rate is amazing at 2.25%. They must have bought this some time ago. Anyways, another great example. So let's go ahead and jump into the math. So this is an interesting scenario because, unlike our first example, we see here there's a pretty big gap between the sales price and the current loan amount. So we input here the listing price that the seller's asking for at this moment. The current loan amount, this number can change over time. So if the listing's been on the market for a while, This number might be a little bit higher, a little bit lower. Using those two numbers, we come up with our estimated gap, right? This is the difference between the sales price and the current loan amount. So the seller is willing to allow someone to assume this, but you got to figure out a way to bring this to the table. How do you do that? How do you address the gap? It's negotiable. Things are negotiable. So at this point, we see there's a gap of $364,000 because the seller is asking for the total sales price of a little over 1.1, almost 1.2. Now, let's say the market doesn't justify that, right? Let's say in our offer, based on the sales prices in the building and the community, we want to adjust this and we want to adjust it down to 1.1 flat, right? What we see is our estimated gap shrink immediately, right? Because we cut $88,000 off the top here, and that reduced our gap to 276,000. So this is strategy number one in my book, is look at the market value of the home and ask yourself, are you paying the seller more because you're assuming their loan, or are you actually paying market value for the property if you give the seller what they want? Your agent will help you kind of break this down. But yeah, if you look at sales in the building and they're all at 1.1 or below, there's got to be a good compelling reason as to why the seller's asking for more than that. Seeing here, again, this amount will change, but it's not negotiable, right? This is already on the books. So by doing the assumption, you're just agreeing wherever this number ends up at the end of your transaction, which it should be close to this, you're going to take it over. Cool. So here's your only negotiating point as far as the price is concerned, right? Lower that is, lower this is. How do you address it? In the form of cash, right? That's the easiest way. Probably the cleanest way is to just tap into savings. If you have $364,000 in our example earlier, it was only a few $1,000 gap that was needed. So there's definitely options in between this and that one. But yeah, cash is probably the easiest way. Second mortgage, and actually it should be like cash or HELOC, because yeah, cash or HELOC. I mean, you're doing the HELOC in order to get cash, right? So it's not like, and I mean, I guess you're doing a second mortgage to get cash too. But the thing is, most of these servicers, they don't want to over leverage the property, right? There's already one more. An important distinction here is that a second mortgage is going to be on the property you're buying currently, whereas the HELOC is hopefully coming from another property that you own. Lenders don't want to over leverage the property that you're purchasing. So if you're assuming a loan and that's already 60, 70, 80, 90, maybe even 100% of its current value, they're not going to want to see a second mortgage on the property that would take that loan to value even higher. Mortgage on it. They don't want two mortgages on it that could potentially be an issue if and when there's a foreclosure. So they're probably not going to let this one happen. A second mortgage, there might be some, and depending on the current loan value of the property, you could find another option here. But in my experience, it's mostly cash or a HELOC in order to get cash, and that's how you address the estimated gap that we see between the sales price and the loan amount. One thing to keep in mind is that in an assumption, you're still having to qualify for the loan, right? We can't just assume this and, no one's going to look at our income or look at our assets or look at our debt to see if we can actually afford it. So this is something that's going to happen during the escrow period. A lot of times lenders will want to see 40% of your monthly income or less dedicated to debt. You have zero debt, no car payment, no credit cards, student loans, anything, and you're only worried about paying this mortgage along with its maintenance fee, taxes, etc. Of a 40% DTI, the required monthly income would be right around the 13,000 mark. So this is a good two-step measure. Is like anytime you look at a potential assumption, you're asking yourself, okay, what's the gap and how do I address it? and then can I qualify for this mortgage? So if you come across a situation and you're like, okay, can't qualify, I can't address this gap. This is too much. I don't have the cash. I don't want to spend the cash, whatever that is. That's fine. So you move on. But if he makes it past this test, apply the next, being the minimum qualifying income. And this is just the guide. There's plenty of situations where DTI can go higher than this. Um, but in general, you don't want to over leverage yourself. And so it's important that we keep this in mind. Other things to think about when it comes to assumptions. VA eligibility is a big one. So a lot of when we talk about assumable loans, VA, FHA, and USDA, like automatic yes, basically, from their standpoint. I go through underwriting. But when we're talking about eligibility, right? If you are eligible for a VA loan, you're basically transferring the loan, right? And it's hold on whoever's eligibility. So current seller, once they allow the buyer to assume the mortgage, they're basically free and clear to use their entitlement as long as their entitlement is good standing prior. If the buyer doesn't have enough entitlement to cover the full value, that could be a challenge. That could be an issue that limits the seller's remaining entitlement. And then if the buyer is not VA eligible themselves, then the seller's entitlement will definitely be impacted. So as far as that consideration is concerned, it's very, very important. Entitlement, that's something that you have to think about. Two, underwriting is usually required. This is something we talked about earlier. So you're going to work with the current loan servicer's underwriting team. Could be a little slow. Um, I would say 30 to 90 days would be a good estimate. Types of loans, conventional financing, it's very rare that you'll come across that type of loan, that type of mortgage, and it'll allow an assumption. VA definitely will. FHA and USDA definitely will be closing costs just like any other mortgage, any other, home purchase, assuming any sort of government loan mortgage. It's totally doable. There's a ton of options on the market right now. Um, it's really just a matter of getting the information, determining, if it fits, right? Those two tests, very simple. Can we address the gap? And then can I qualify for the payment? Right. If you have questions on whether or not you can actually afford that payment yourself, get pre-approved with a mortgage broker. We specialize in looking at your income and giving you a budget that works best for you, looking at both the interest rate and the term of the loan and many other factors to come up with a solution that meets your needs. Thanks for watching.